Please refer to page 832. After considering the 5-step model, we have to consider the specific applications, which is the usual issue in exam. The first factor we consider is loyalty program. For example, when the customer pay $1, with the $1 spent, the customer earn 1 point. This point the customer earn, they can use the point to redeem future goods and services. The issue is this represent a material rights to the customer? If it's a material rights to customer, it's considered as performance obligation to the entity. If it's a performance obligation to the entity, when we do the allocations, we must allocate the transaction price to this loyalty point based on standalone selling price. Please refer to page 848. Customer options to acquire additional goods and services. Now we're discussing the transaction relating to customer options to acquire additional goods and services at a later date for free or at a discount. Take for example, loyalty point, discount voucher. Every $100 spent, it comes with 10 points or 20% discount to purchase goods and services at later stage. This is very common. You go to supermarket, every dollar you spend, you can earn some point to purchase additional goods and services at a later stage. These customer options to acquire goods and services, we have to consider whether this is considered as a material rights to customer. If it's a material rights to customer, it represents a performance obligations to the entity. If it represents a performance obligations, a portion of the transaction price must be allocated to these performance obligations. If it's not a material right, normally we just ignore because it represents a marketing offer. How do you know whether it's material rights? First, could the customer obtain the right without entering the transaction now? If the answer is yes, then it's not a material right, it's just a marketing offer. The company offers to everybody 5% discount on the goods and services they are offering. This 5% is not a material right to a customer, it's just a marketing offer for advertising and promotional purposes. This does not give rise to a performance obligations. If the answer is no, in order to obtain the discount, the customer must enter the contract now. If you pay for the service now, you are entitled to purchase the goods and services in the future at 15% discount. You pay for $1 now, you are entitled to 2 points, and this 2 points allow you to redeem future goods and services. Without entering the contract now, you are not entitled to the point, you are not entitled to a discount. The customer must enter a contract in order to entitle to the rights. Then the second question we're going to ask, does the options give the customer to acquire goods and services at a price that reflects the standalone selling price? Other people can purchase the good at 5%. After entering this contract, I also can purchase the goods and services at 5%. This 5% is not a special rights. It's a rights that which everybody without entering the contract also entitled rights. In this case, it's just a marketing offer. If the answer is no, the customer is able to purchase the goods and services at a better price as compared to others. For example, without entering the contract, the customer can purchase the goods and services at a discount of 5%. With the contract, the customer can purchase the goods and services at a later stage at 15%. The extra of 10% represent a material rights. If it's a material right to the customer, it's a performance obligations to the entity. If it's a performance obligations, a portion of the transaction price must be allocated to the performance obligations. If the discount voucher or loyalty point represent a material rights, a portion of the transaction price must be allocated to the discount or the loyalty point. If it represents a material right, means it represents a performance obligations. A portion of the transaction price must be allocated. Please refer to page 861. Question 23.1 is a module A questions. This question is to discuss the accounting for loyalty point, or sometimes we call this as reward credit, with the applications of step 2 to step 4 of the revenue model. Study the questions, understand the issue, We're going to discuss this question shortly. We're required to discuss and calculate the amount of revenue in relation to the 200,000 loyalty point granted before 1st April 2008 to be recognized in the year 2009 and 2010. A marks. Discuss and calculate. The entity is a regional chain of convenience store. It operates a customer loyalty program. It grants program members loyalty point when they spend a specific amount on the goods and services in the store. Program members can redeem this point for future goods and services. Does this loyalty point represent a material rights? Answer should be, it's a material rights to customer. Without entering the contract, the customer do not earn the point. The point allows the customer to redeem for goods and services at a price which other customer would not entitle. This represents the material rights to the customer. It represents a performance obligations to the entity. If that's the case, a portion of transaction price should be allocated to this loyalty point. Before April 2008, the company granted 200,000 points for $400,000 sales of goods and services. The management expected 180,000 points to be redeemed. Each loyalty point allowed the customer to redeem $1 worth of goods or services in the future. On or before 1st April 2008, the company received cash of $400,000. This $400,000 is the transaction price. Credit revenue in profit and loss. This revenue in profit and loss represent the goods and services transferred to customer. Credit the loyalty point. This loyalty point represent the contract liability. A portion of this must be allocated to these two under the contract based on the stand-alone selling price. We need to know what is a stand-alone selling price. The standalone selling price for the sales of the goods and services, unless the question indicates otherwise, should be equal to $400,000. Without the loyalty point or with the loyalty point, the company is selling the goods and services at $400,000. This $400,000 is directly observable because these are goods and services the entity is selling at the store. Loyalty point, it appears that it's not directly observable. They do not sell the point separately. We have to estimate this loyalty point. The question mentioned that 200,000 points issued, each point is worth $1, and the company only expects 180,000 points to redeem in the future. The standalone selling price of this loyalty point should be equal to 180,000. Over the total of these two, 580,000 multiplied by $400,000. This is the amount that we're going to allocate to these two components. 180 over 580 multiplied by 400. Based on our allocations, 275,880. 124,120. This is the allocation that we have to make at the transaction date, 275,880 and 124,120. 275,880 is the revenue recognized for the transfer of goods and services, and 124,120 is the point earned to be redeemed for goods and services in the future. This represents contract liability. The loyalty point granted, which allow customers to redeem goods and services at the below market price, represent a separate performance obligations under contract, because this represents a material right to the customer. The customer only entitled a right if they enter the contract now. It allows the customer to redeem for goods and services below the standalone selling price in the future. A portion of the transaction price should be assigned to this loyalty point. Two components here, the goods and services and loyalty point. After the allocations, this is the amount that we discussed earlier on. This amount is considered as a contract liability. It's recognized revenue only when the loyalty points are redeemed. In the year 2009, 81,000 points were redeemed in exchange for goods and services. At the end of 31st March 2009, the company continued to expect 180,000 points redeemed in total in the future. Latest estimate, 31st March 2009, year end. For this period, 2009, out of 124,120, a portion of this redeemed, 81,000 points over the estimate of 180,000 points multiplied by 124,120. This is a point that redeemed. The company have discharged the obligations. We must account this as revenue, 55854. The entry you have to pass is debit loyalty point or contract liability and credit revenue to profit and loss for the year 2009. 31st March 2010, year end. For 2010, go through the process again. The question mentioned that for the year 2010, another 90,000 points were redeemed. Now the management have revised the total estimated point to be redeemed is equal to 195,000. This is the latest estimates. 81,000 points last year plus 90,000 points this year. In total, 171 points redeemed. Based on the latest estimates, the management think that in total there will be 195,000 points to be redeemed, multiplied by the amount of contract liability we defer over the periods. 81 plus 90 over 195, multiplied by 124, 120. The amount that we're supposed to recognize to date is equals to 108,844 minus 55,854. This is the amount that we recognized last year. This will be the current year adjustment equals to 52,990. Again, we have to debit loyalty point or contract liability and credit revenue to profit and loss for the year 2010. First step, we must allocate the $400,000 to the sales of goods and the contract liability. Sometimes we call this as a deferred income, unearned income, or we can call this as a contract liability. This amount will be recognized over the period based on the estimate. The first year, we recognize 55,854. In the year 2010, we recognize 52,990. Look at suggested answer, next page. For the year 2009, based on the latest estimates, the amount which we recognize in P&L should be equals to 55,854. In the year 2010, cumulatively we should recognize is this amount minus whatever we recognized in prior year. This will be the current year adjustment in profit and loss for 2010. Please refer to page 832. Principal versus agent transactions. If it's a principal transactions, we account revenue based on gross. If it's an agent transaction, we account revenue based on net basis. How do we tell whether it's a principal or agent transaction? Please refer to page 849. Principal versus agent transactions. For example, this is entity, the supplier, provide goods and services to the entity at $30. The entity provide goods and services to the customer at $34. Should the entity account for this transaction based on gross basis? Should the entity account for this transaction based on net basis? When you say gross basis means revenue reported by the entity is equals to 34 and the cost of goods sold is equals to 30. In other words, there should be a gross profits of $4. Revenue based on gross. Net basis means based on commissions income of $4. So the issue is, should the entity account this based on gross or based on net? Depending on whether the entity is it a principal or is it an agent. If the entity is a principal based on gross, if the entity is agent based on net. How do we know whether the entity is a principal or agent? Does the entity control the goods and services before it transfers to the customer? If the answer is yes, this indicates the entity is a principal. If the answer is no, the entity is an agent. Does entity obtain control of the goods and services before transferring to customer? If the answer is yes, this indicates that it's a principal. If the answer is no, this suggests that it's an agent. We have to consider the factors given under FRS 15. There are three factors that we must consider. Does the entity obtain control before it transfers to customer? Consider the three factors. After we consider three factors, it concludes that yes, you obtain control, then the entity is a principal. Principal account revenue based on gross. If the answer is no, then it's an agent. Agent account for revenue based on net commission basis. The entity is considered as a principal. Revenue should be reported in gross if we control the goods and services before transferring to customer. An entity is considered an agent and account revenue based on commission basis if the role is to arrange for another party to provide goods and services. The following are factors to consider that the entity is a principal. The entity have a primary responsibility to ensure their goods and services to the customer. Who ensure their goods and services to customer? Is it the entity or the supplier? If the entity is the one ensure their goods and services to a customer, this indicates the entity is a principal. If whether there's goods and services for the customer, the primary responsibility is not the entity, the supplier is the one that ensure their goods and services to a customer, then this entity represents agent. Second factor is the entity have inventory risk at any point during the transactions. If the customer return the goods, the entity suffer. If the entity is able to sell the goods to the customer earlier than expected or later than expected, if the entity is the one that subject to the inventory risk, then the entity is a principal. If the customer return the goods, entity return the goods to a supplier, entity do not suffer or do not benefit more. This indicates that the entity is just an agent. Number 3. The entity has the discretion in deciding how much to sell, who to sell, and how to sell. The price of these goods and services, who to sell, how to sell, entity is the one deciding. Then this indicates that entity is a principal. But if entity is only a party to assist the supplier in selling these goods and services to customer, how much to sell, who to sell, in what form to sell, the supplier is the one that deciding. This indicates that entity is just an agent. Please refer to page 865. Question 23.3. This is a Module A questions to discuss the issue on significant financing components as well as principal versus agent transactions. Study the questions, understand the issue. We're going to discuss this question shortly. Part A, we are required to prepare the journal entry to be entered in the month of October, November, December for 2013 for the two sales transactions, assuming the effective interest rate is 13% per annum, unless the question indicates otherwise. YCL is a sole distributor of truck in Asia. The truck itself is considered the goods or the products carried by this entity. Trucks are manufactured in Europe. Shipment is made monthly to Hong Kong based on the purchase order placed by YCL to the supplier. YCL offers its customer buying truck models 6 on the following payment term. There are two plans, Plan 1 and Plan 2. Plan 1 I believe is a normal plan. Initial deposit of $50,000 upon signing the provisional sales order. $400,000 payment upon delivery of the trucks. The standalone selling price for this truck is equals to 50 plus 400 equals to $450,000. For Plan 2 is an installment plan. An initial deposit of $30,000 upon signing the provisional sales order and 24 monthly installment of $20,000 each payable in arrears from the date of delivery of the trucks. Plan 2 is an installment plan. The question is, what is the standalone selling price of the trucks for Plan 2? Whether you sell now and receive now, or whether you sell now and receive later, the standalone selling price should be the same. If we sell now and receive later, we receive more. The extra is not the standalone selling price. The extra is a significant financing component. Based on Plan 2, the question mentioned that there's an initial deposit of $30,000 plus $20,000 for 24 months. In total, is equals to $510,000. The standalone selling price should be equals to $450,000. The same figure here. Whether you sell the truck now and receive now, or whether you sell the truck now and receive in the future, the standalone selling price of the truck should be the same, $450,000. But obviously, if you sell the truck now and receive later, you receive more. It's equal to 510 minus 450. The company received extra of 60,000. This extra 60,000 represents the significant financing component. This will be at 13% per annum. Choosing Plan 2 is required to enter in the insurance contract for 2 years at a prepaid premium of $6,000 per truck. Whoever opt for Plan 2, they must buy an insurance coverage for this truck for 2 years with GCC, an independent insurance company with full obligation of the insurance arrangement. The customer have to pay the full insurance premium $6,000 to YCL upon collections of the trucks, and YCL pay $5,500 to GCC on the same date. This insurance contract for 2 years at a premium of $6,000, YCL is acting only as an agent, whereas GCC is considered the principal. The reason is very simple, because who have the primary responsibility to provide the insurance coverage is the principal. Who subject to inventory risk is the principal. Whether there's claim, whether less claim, whether there's more claim, GCC is the one that taking the full obligations. And how much the premium to be charged is not decided by YCL, it's decided by GCC. YCL is only acting as an agent for the insurance contract arrangement. YCL will earn the commissions of $500. Is equals to 6,000 minus 5,005 for every trucks. 12 trucks sold under Plan 1 and 20 trucks sold under Plan 2. The sales order was signed in the month of October. The truck was delivered in the month of November. That means the payment of the installment plan is in the month of December. We are required to do the journal entry for the month of October, November and December. Refer to page 867. Part A is talking about the journal entry. There are two plans, Plan 1 and Plan 2. In the month of October, sales order signed with deposit. There are 12 trucks sold under Plan 1. There are 20 trucks sold under Plan 2. In this case, we must debit cash. We have to take 12 multiplied by the deposit received is equals to $50,000 is equals to $600,000 for Plan 1. I put all in thousand. And credit contract liability, or we can call this as deposit liability. This is relating to Plan 1 and this relating to Plan 2. We do the same entry for Plan 2. Debit cash, credit contract liability. For Plan 2, 20 trucks multiplied by deposit is equals to $30. 600,000 debit cash, credit contract liability $600,000. This is in the month of October. In the month of November, trucks delivered to customer. For the 12 trucks delivered in the month of November for Plan 1, we should recognize revenue, profit and loss. We should take 12 truck multiply standalone selling price $450. In total is equals to $5,004. Debit the contract liability, this amount $600, and the company receive cash for the remaining $400 per trucks. 12 trucks is equals to $4,008. This is for Plan 1. For Plan 2, whether you sell now and receive now or sell now and receive over 24 months, the revenue recognized should be the same. Credit, revenue, profit and loss. It should be based on the standalone selling price of $450. Revenue for the 20 trucks is equals to $9 million. We need to debit contract liability, the amount recognized last month, reverse it, $600. We have to account for trade receivable. It's the balance of these two, 9,000 minus 600. The 8.4 is the amount that we can receive over the remaining 24 months. Plan 2, remember, the company will receive a premium from the customer, $6,000, debit cash, customer. This amount will be 20 trucks and each customer they'll collect $6,000. In total, the amount collected from customer is $120. Credit cash to GCC. 20 trucks, $5,500 is equals to $110. There's a difference of $10,000. This $10,000 represents the commissions income to be recognized in profit and loss. In the month of December, collections of monthly payment. It does not apply to Plan 1, you only apply to Plan 2. We have to debit cash, 20 multiplied by 20,000 from each customer. In total, the company received is $400,000 cash. Out of this $400,000 cash, we have to credit interest income in profit and loss. The interest income is equal to this amount, 8,004 at 13% per annum. Multiplied by 1 over 12 equals to 91. This 309 is a repayment of the trade receivable in the month of October, November and December for Plan 1, Plan 2. Just to share with you, for Plan 2, there should be a trade receivable at 31st December 2013 is equals to 8,400 minus the payment is 309. The remaining amount is equals to 8091. This represents a financial assets at amortized cost. That's for part A. Refer to suggest answer. In the month of October, the total cash received is equals to $1,002, $600 for Plan 1, $600,000 for Plan 2. In the month of November, the company received cash in total is 4920. This 4920 is for the 12 trucks and the 20 trucks. Then we must reverse this contract liability. There's a receivable 8,004. The sales recognized in profit and loss, it should be 14,400. This 14,400 is based on the standalone selling price. And there's a commission income, and this is the amount that cash paid to GCC. In the month of December, the cash received partly is paying for interest income. For this question, I'm using the figures journal entry to discuss the basic requirement, the general principle of the relevant standards. After having good understanding of the requirement of the relevant standards, in the exam, you are able to offer comments, advice, explanations as required by the questions. Bear in mind, you must put those figure journal entry in sentences for examination purposes. Now look at part B. YCL is planning to expand its business to Guangzhou in cooperation with BT Vehicle Limited, a local cars dealer. Discuss the factors for considerations in the contractual arrangement with BT so that BT will only act as an agent of YCL in selling the trucks. YCL through BT to customer. Now we're talking about YCL, the truck to the customer. For this arrangement, we want to ensure that YCL is a principal and BT is only acting as an agent. To ensure that YCL is acting as a principal, BT is acting as agent, it means that BT is an agent is only earning a commissions. And BT do not have control over the trucks before it transferred to customer. The first factor to consider is that YCL have the primary responsibility to ensure there are trucks to the customer. YCL is the one that is subject to the inventory risk on the trucks to the customer. If there's a return, YCL suffer. If there's no return, YCL benefits. If they're able to sell at a higher price, YCL benefits. BT is just acting as an agent to facilitate the sales. The third factor to consider is that the price of the trucks, YCL is the one that deciding. How to sell, who to sell, is it sold under Plan 1, Plan 2, Plan 3? YCL is the one that deciding. BT may be a party that provide advice, suggestions, but eventually YCL is the one that deciding how to sell, how much to sell, who to sell to, under what plan. The issue is we want to ensure that YCL is acting as a principal, BT is acting as agents. We must ensure that BT do not have control over the trucks before the truck is sold to customer. YCL is the one that have control. We have to consider three factors. When another entity is involved in providing goods and services to the customer, the entity should consider the nature of its promise to customer. If the entity obtains control of the goods and services before it's transferred to the customer, that means the entity is acting as a principal. If the entity does not control of the goods and services before it transferred to the customer, the entity is acting as an agent. The following feature must be contained in the contractual arrangement between BT and YCL to ensure that YCL is acting as a principal, BT is acting as an agent. Brand responsibility, inventory risk, who is the one that deciding the selling price. In terms of remunerations or share of profits to be provided to BT, normally if it's an agent, agents will only earn a commissions at a predetermined rate at the start of the contract. Please refer to page 871. Question 23.5 is a modular question. This question is to discuss the applications of Step 2 and Step 5 of the revenue model together with the issue on principals versus agent transactions. Study questions, understand the issue. We're going to discuss the question shortly. Advise and explain factors that will be considered in determining whether LCL should recognize revenue from the sea freight business gross or net of the fee that is paid to the shipping company. Whether LCL should account revenue based on gross or net, it depends on whether LCL is a principal or whether LCL is an agent. If it's a principal, based on gross. If it's an agent, based on net. 10 marks. Do a detailed discussion because it's a 10 marks questions. List out the issue, list out the principle, apply to the questions. Based on what described above, formulate an analysis on the company revenue to be recognized from the sea freight business with the corporate customer You are only required to focus on identifying separate performance obligation. That means these are talking about step 2. Recognition of revenue, whether it's a point in time or over time. This is talking about step 5. 10 marks should be focusing on step 2 and step 5. Do not need to mention step 1, 3, 4. Part C, LCL is assessing the amount of loss allowance recognized against the account receivable. This is talking about impairment allowance under FRS 9. This impairment allowance must be based on expected credit losses approach. Based on the data provided above, assuming all customers have a credit period of less than 12 months. This is a simple account receivable. We have to apply the simplified approach. In other words, we must use the lifetime expected credit losses amount. We do not need to monitor whether it's high risk or low risk. You are required to calculate the loss allowance would have been recorded at 31st December 2017. 3 marks. For Part C, you are required to calculate the amount should be recorded. Part A is to discuss whether the entity is acting as a principal or agent. Part B is to discuss the application of Step 2 and Step 5. Part C is to account for the loss allowance for receivable using the lifetime expected credit loss amount. LCL is providing freight services that deliver goods for its customer over the sea using vessels owned by a third-party shipping company. It also owns a warehouse that provides logistics services. The warehouse basically is for storage. The vessel is for transportation services. To request for the transportation services, corporate customer place their order over the internet as the needs arises. LCL will then be responsible for identifying the shipping company they want to use to deliver the goods. The price will be based on what have been negotiated between LCL and the specific shipping company. The customer do not have the choice as to which shipping company or which vessels LCL use for its delivery of their goods. If anything goes wrong, LCL is directly answerable to the customer, who have the primary responsibility to ensure the goods are delivered to the designated locations. LCL have the primary responsibility. LCL is the one that deciding which forwarding company to use for the respective request or job. The customer have an unconditional obligation to pay only when the service has been completed. If the goods not delivered on time, LCL will not be able to collect the fee. The shipping company is not the one that is responsible. Based on this paragraph, it indicates that LCL have the primary responsibility to ensure the service are fulfilled. The price to charge customer is a negotiation between LCL and the customer, and the fee to pay to shipping company is negotiation between LCL and the shipping company. The customer do not have control over the shipping company services. All this indicate that LCL is acting as a principal. LCL should account revenue based on gross. LCL recognize revenue whether as gross or net of the fee. You have to list down the issue and list down the requirement. When another party is involved in providing goods and services to customer, the entity should determine whether the nature of the promise is a performance obligation to provide the specific goods and services itself, principal, or to arrange for the goods and services to be provided by others. That means it's an agent. An entity is a principal if it controls the goods and services before the goods and services transferred to its customer. When an entity is acting as a principal, the entity should recognize revenue based on gross amount of considerations. Otherwise, the entity should recognize revenue based on net. The indicators suggesting that the entity obtained control before it transferred the goods and services to customer are as follows. 3 factors to consider. The overall business model of LCL appears to be that it promised the customer to deliver goods and services to the destination. LCL is the one that have the primary responsibility to ensure the goods are delivered to the agreed destinations. How we do it is within the control of LCL. It's not within the control of the customer. It does not matter whether the company is providing the service using its own vessel or subcon to the third party to provide goods and services. Even though LCL does not commit itself to obtain the service from a shipping company before it obtains control from a customer, it seems that LCL may be acting in the capacity of a principal for the following reason. LCL have the primary responsibility for ensure goods and services to be delivered to the agreed destinations. How we do it is not within the control of the customer. LCL can use any of the shipping company to provide such services. LCL is the one that directs what service is required from a shipping company. LCL has the discretion deciding how customer is charged for the transport services. And there's no indication that LCL cannot use the slot book for customer A and to use for customer B. As long as I make a reservations with the shipping company, which order I'm going to fulfill is up to LCL. It's not up to a shipping company, it's not up to a customer. The customer have no control of the shipping company to use. The customer do not have a right to direct the shipping company to perform the services. In this case, LCL obtain control of the right of the shipping services before those services are provided to customer. Conclusion is LCL is a principal. If it's a principal, it should recognize revenue based on gross basis. Part B, we have to apply Step 2 and Step 5. For Step 2, we have to identify how many performance obligations under contract with customer. And are these considered as distinct or not distinct? If it's distinct, we account separately. If it's not distinct, combine until they are distinct. For items that are pending to be loaded on board of the vessel, due to the needs for further packaging together with other order, they will be stored in LCL warehouse until all the goods of the same shipment come together. Such storage service is not specifically billed in the online order. LCL do not separate bill the customer, it's part of the package. Although it's part of the package, do we need to account separately? It depending on whether it's distinct or not distinct. Based on the description given to us here, technically there should be 3 performance obligations: the transport service, the packaging service, the storage service. The suggested answer only mentions 2 performance obligations, transport and the storage, because it assumes that the packaging and the storage is considered as one performance obligations. Because the company do not do packaging if there's no request on doing storage. In this case, the packaging and storage is considered one performance obligations. Do we need to account these 2 separately, or do we account this as one single performance obligation? It depending on, first, whether are they capable of being distinct, and are they capable of being distinct in this contract. We may assume that they are capable of being distinct. In other contract, if customer want to rent a storage space to store the item, the company should be able to charge them the storage fee without doing the transportations. These 2 are capable of being distinct. But are they capable of being distinct in this contract? The answer is no. Because in order for them to provide the transport service, they must also provide the storage service. Without providing storage service, they cannot do the transport service. In this case, these 2 are capable of being distinct in other contract, but it's not distinct in this contract because the transport service is dependent on the storage service. So we account this as one performance obligation in these questions. Identifying separate performance obligations, referring to Step 2. First, we must identify performance obligation in the contract. Second, do we need to account for the performance obligation separately if it's more than one performance obligations, depending whether it's distinct or not distinct. Promises are separately identified, accounted for separately if the promised goods and services is considered distinct. How do you know it's distinct or non-distinct? We have considered the criteria. They must be capable of being distinct, and they are distinct in this contract with the customer. For this question, the company promises to a customer include the following: delivery of the goods and storage before the goods are consolidated to go on board. This storage includes the packaging services. While each of the above could be capable of being distinct, the company is a logistics company. A logistics company, besides providing transportation services, they also provide storage services. These 2 are capable of being distinct in other contracts. In the context of this contract, the storage is part and parcel of the journey that the goods need to make in order to be transported overseas. In other words, storage and delivery services are highly interdependent or highly interrelated. The fact that is not separately mentioned in the online order would appear to suggest that the storage together with the transportation services is as a single performance obligation. I believe you know the answer, but you must explain the answer. This is the principle, this is the applications. Now look at number 2. Do we recognize revenue over time or do we recognize revenue at a point in time? Step 5. Revenue should be recognized when there is a transfer of control. Control is transferred over time if any of the following is relevant. The customer simultaneously receive and consume the benefits as company perform the service. The company performance create and enhance an assets under the control of the customer. The company does not create an asset with an alternative use to the entity, and the entity have an enforceable right to payment for performance completed to date. If any of these apply, then we recognize revenue over time. We should apply the first one, providing transport services. For example, you need to deliver the goods to another location, assuming it's 50 km. After 20 km, in theory is customer already consumed the service for the 20 km. If there's a need, the customer may get another one to deliver the goods for the remaining 30 km. The customer simultaneously receive and consume the benefits as the company perform the service. If LCI during the goods part of the way, another entity would not need to redo the service. You appear that the perform obligation will meet the criteria of revenue over time as the customer simultaneously receive and consume the benefit as LCI perform the transport service, unless indicated otherwise. Part C, you are required to account for the impairment allowance for trade receivable. Generally, LCI customer enjoy a 30-day credit period. The following set out the aging analysis of the account receivable, the provision metric commonly used in practice. Total receivable outstanding is equal to $80720 million. How much allowance do we recognize? We simply just multiply equals 2. This is the amount that we should recognize as impairment allowance for the trade receivable. No discounting is required because it's 30 days credit period. This amount is after considering the lifetime expected credit losses. Can I look at the suggested answer? This is the balance given to us multiplied by the loss ratio equals to expected credit losses equal to 2196. Based on lifetime expected credit losses. Please refer to page 832. Third, warranty. There are two types of warranty. One is assurance warranty. The other is service warranty. If it's assurance warranty, we do not account separately. Assurance warranty is to assure the goods and services. In order for the customer to buy my goods and services, I give them an assurance that my goods and services are of certain standard. In this case, assurance warranty is not accounted for separately. But if it's a service warranty, we account as a separate performance obligations, means a portion of the transaction price must be allocated to service warranty. We have to differentiate whether it's assurance warranty or service warranty. If it's an assurance warranty, we must account for provisions for warranty costs. If it's a service warranty, we account this as a separate goods and services under the contract, separate performance obligation. Please refer to page 851. Accounting for warranty. There are two types of warranty. One is service warranty. If it's a service warranty, it represents a performance obligations. If it's a performance obligations, a portion of the transaction price must be allocated to this service warranty at the start of the contract. According to step 2, we must identify this is a performance obligation separately. And step 4, a portion of the transaction price must be allocated to this service warranty. If it's an assurance warranty is not a separate performance obligations. It's to assure the products and services sold of certain standards. This is considered as not distinct. If it's not distinct, then we do not account separately. Instead, we account for provision for the warranty cost in accordance with AS37. Try to recall what you learned about AS37. A provision for warranty cost is only recognized when you meet the criteria. There's a present obligation, settlement is probable, reliable estimate can be made. We need to know whether it's a service warranty or whether it's an assurance warranty. These are the factors that we must consider. In the exam, you have to exercise a little bit of judgment to discuss all these factors. Does the customer have an option to buy this warranty? If the answer is yes, then it's a service warranty. If the answer is no, then we consider other factors. For example, you purchase an Apple phone, and this Apple phone comes with 1 year warranty. On top of the 1 year warranty, normally they will try to upsell by asking you to get the Apple Care, the extra 2 or 3 years warranty. The extra 2 or 3 year warranty is an option that the customer can choose to buy or choose not to buy. This extra warranty is considered as a service warranty. Portion of money received is for the service to be provided in the future. This will be accounted for as a performance obligations. If the answer is no, if the warranty that attached to the products and services is required by law, then definitely this is an assurance warranty. It's not to provide service, it's to assure the product and services of certain standards. If the answer is no, is the coverage period considered as short? The standard did not define what is long or short. It's based on the product and services. A warranty for a mobile phone and a warranty of an aircraft, the warranty period will not be the same. To assure the quality of the product and services, a 1 year warranty for mobile phone is reasonable. A 3 year warranty for an aircraft is also reasonable. Is the coverage period considered reasonable for the coverage of the quality of the product and services? If it's considered as yes, short period, then this is considered an assurance warranty. If the answer is no, does the promised warranty involve providing assurance of the product complies certain agreed spec? If the answer is yes, then it's an assurance warranty. Otherwise, it's a service warranty. Service warranty, a portion of transaction price must be allocated service warranty. If it's assurance warranty, you account provision for warranty costs. Okay, look at the example below. The company sells handsets that include assurance warranty for the first 6 months. The company also offers an optional extended coverage under which will repair or replace any defective parts for 1 year after the expiry of the assurance warranty. This extended warranty is not to assure the product and services, it's to provide additional services to customer. The transaction price is equals to $800 and the standalone selling price for the handset is $780 and the extended warranty is $100. Assurance warranty is not a distinct performance obligation under contract. It's part of the handsets. So, in the contract there are 2 performance obligations, handset as well as extended warranty. The standalone selling price of these 2 is equals to $780 and this is equals to $100. In total is equals to $880. The transaction price, as the question mentioned, is equals to $800. How to do the allocations? We have to take 780 over 880 multiplied by 800. 100 over 880 multiplied by 800, 709.91. At the date we received the cash of $800, a portion must be allocated to the extended warranty. It's a performance obligations. If you account for sales, we must account for the cost of sales, $600. At the same time, we must account for the provisions for warranty costs, the $40. Service warranty is within the scope of FRS 15. Provisional warranty cost is within the scope of AS 37. Extended warranty is the service warranty, is considered as a performance obligation. We must account separately. This represents the contract liability under FRS 9. Please refer to page 883. Question 23.9 is a FEA questions to discuss the accounting for warranty under a sales contract. Study the questions, understand the issue. We're going to discuss these questions shortly. For this question, assuming you are the finance manager, with reference to the relevant standards, advise the CFO regarding the impact of the 5-year standard warranty and the extended warranty on the consolidated financial statement for the year end 31st March 2017. 12 marks. In the exam, you must come out with 12 to 13 points. For examination purposes, there are 3 simple steps. Identify the issue. In this case, it's accounting treatments for the warranty. List down the requirement. You have to identify whether this warranty is a service warranty or assurance warranty. Extended warranty, we treat as a separate performance obligations, a distinct goods and services. A portion of the transaction price should be allocated to extended warranty and recognize the revenue over time. But if it's an assurance warranty, it's not distinct. It's to assure the products and goods and services of certain standard to meet certain specifications. For assurance warranty, recognize provision for warranty costs when the recognition criteria under AS 37 are met. This is the requirement. Step 3. Advise, discuss, and conclusions. How are all these affects our financial statements? The principal activity of the entity, manufacture and sales of kitchenware, electrical item, manufacture and sales of casings for kitchenware and appliances. The company has provided a 5-year standard warranty to customers free of charge upon purchase of the company products, which cannot be sold separately. This warranty is a standard warranty, cannot be sold separately. It appears to me this is considered as an assurance warranty, but I do not conclude this is an assurance warranty. You have to discuss the factors to consider. The customer can extend the warranty, extended warranty, with a payment of additional fee upon the expiry of the 5-year standard warranty period. The company have a policy to provide a full refunds to customer if they are not completely happy with the company product within 30 days after products are delivered to them. This is referring to rights of returns. A right of return is accounted for as a variable considerations. But the question did not want us to discuss this. The question just wants us to discuss the accounting treatment for the standard warranty and the extended warranty. First, we have to consider, are these considered as a distinct goods and services? If the answer is yes, then it's considered as a separate performance obligations. A portion of transaction price should be allocated to the distinct goods and services. For extended warranty, definitely yes, it's a performance obligations. But the standard warranty we have to discuss. Given that this cannot be sold separately, it appears it's not performance obligations, but we've considered other factors. Period of coverage. Is it considered as reasonable? 5 years, sometimes may be too long. If it's too long, this may represent assurance plus service warranty. Given that this is 5 years, if it's a 5-year standard warranty, it may comprises of assurance and extended warranty. Warranty, there are 2 types. One is assurance type warranty, one is service type warranty. First, we consider the 5-year standard warranty. Since the 5-year warranty cannot be sold separately, you have to refer to the questions. Use the relevant information to support your argument. Judgment is required to determine whether this warranty or part of this warranty provide the customer with a service in addition to the assurance of the products comply with agreed upon spec. In other words, we have to consider, is this warranty considered just an assurance warranty or is an assurance warranty come service warranty? In assessing whether the standard warranty provide customer with a service in addition to assurance, these are the factors that we must consider. Whether the warranty is required by law. If the warranty is required by law, then this suggests that this is an assurance warranty. The length of the warranty coverage. The longer the coverage period, the more likely that the warranty is considered as a service warranty. Besides providing the assurance of the product sold, at the same time the company is also giving some service to the customer. The nature of the task that the group promised to perform. We have to consider under the arrangement, what is the obligation under the warranty? Is it to ensure that the products comply with certain agreed specs? If the answer is yes, this is considered as an assurance warranty. We have to consider the term and conditions for this standard warranty. Based on the facts and circumstances, if the entity concluded that the 5-year warranty does not contain any service elements, then this is an assurance type warranty. We have to recognize provisions in accordance to AS 37. We have to consider the recognition criteria. There is a present obligation as a result of sales of product with warranty. Settlement, is it probable? Reliable estimate can be made. If the answer is yes, a provision for warranty cost should be recognized under AS 37. However, if the transaction is a combination of assurance type warranty and service warranty, then the company should allocate the transaction cost to this service warranty separately. If the entity cannot reasonably account for them separately, the entity should account both warranty as a single performance obligations. As for the extended warranty, because it can be sold separately, customers have the option to buy or not to buy. This is a strong indication that this is a service warranty. If it's a service warranty, treat this as a separate performance obligation under FRS 15. Please refer to page 832. Number 4. Repurchase arrangements. Please refer to page 850. Repurchase arrangement. For contract involve the sales of an asset with a promise option to buy back. The question is that do we account this as revenue? Revenue should be recognized when there is a transfer of control. If there is no transfer of control, we do not recognize revenue. In accordance with FRS 15, there are two forms of repurchase arrangement. One is repurchase arrangement in the form that the entity have a rights or obligation to buy back. Another form of repurchase arrangement is the entity will only buy back if the customer requests to do so. The first type is considered as a call or forward contract. The second type is a put contract. If the entity have a rights or obligation to buy back, is the repurchase price more or equals the original selling price? The entity is the seller, this is the buyer. Selling price to buy back. Should the entity account this as a sales of the goods and services? If the selling price is equals to $50 and the entity have an obligation or rights to buy back at $56. In this case, the repurchase price is more than the original selling price. The entity will treat this as a financing arrangement, which means the entity is not selling the goods. The entity is using the goods to get a loan. If the repurchase price is equal to 56 and the original selling price is 50, that means the $6 is considered as interest. If the answer is yes, in this case it's considered as a financing arrangement, using the assets to get a loan. I receive 50, I promise to pay back 56. The $6 extra is considered interest over the period. If the answer is no, the repurchase price may be equals to $30. Then we have to account this as lease arrangement. Apply FRS 16. If the entity have obligation to buy back at the request of customer, the original selling price is 50. Is the repurchase price more or equal to original selling price? For example, it's 56. Yes. That means customer can sell back for 56. Is the repurchase price greater than the expected market value at the date of repurchase? If the market value at the date of repurchase is equals to 40 and the customer have a right to sell back at 56 and the value expected to be is 40 at the date of repurchase, then we treat this as financing arrangement. The company is just getting a loan from the customer. The buyer have a right to sell back if the market value at the date of repurchase is equals to 40. In this case, it's likely that the customer is going to sell back because the market value is only 40 and sell back for 56. Company receive 50 and they're going to pay back the 56. In other words, the $6 represent an interest to the entity. It's a financing arrangement. If the answer is not true, then we have to ask one more question. Does the customer have significant economic incentives to exercise the options? If the customer have significant economic incentive to exercise the options, then we treat this as a lease arrangement. If the answer is no, we treat this as a sales with a right of return. Sales of right of return means we treat this as a variable considerations. Is it likely that the customer is going to sell back? It's likely that the customer is going to return back, then we cannot account this as revenue. There's no reason to believe the customer will return back, then we can account this as revenue. Can refer to this example here. AB sell equipment to customer for 80. AB have the rights to buy back for 89. Repurchase price. If the repurchase price is more than the selling price, then we treat this as a financing arrangement. Control of the equipment does not transfer to a customer because AB have the right to buy back the equipment and the customer is limited in his ability to direct the use of the equipment, so it's a financing arrangement. At the start of the contract, we should account the $80 as financial liability, and when they buy back, you have to pay another $9. This $9 is considered interest expense in P&L for the 1 year period. Please refer to page 832. Number 5. How do we account revenue from construction contract? Please refer to page 858. Let's do a quick discussion on accounting for construction contract, i.e. construction services. When dealing with construction contract or construction services, the first step is to examine the overall contract positions. Take for example, the price of the contract is equals to $50. This is determined in accordance to step 3, transaction price. Assuming the total cost to incur to fulfill the contract are estimated to be $42. Based on $50 price, $42 cost, there's an expected profits of $8. If this contract is profitable, we should consider how to account for these profits over the period of the constructions. However, if the cost to incur equals to $54, we should expect a loss of $4. This contract is considered as onerous. In accordance to AS 37 and FRS 15, we must account provisions for this loss 100%. If it's profitable, we consider how much of the profits to be recognized over the period of the contract. If it's a loss, the loss must be recognized 100% immediately. The second step is to determine the progress of the contract to date. In other words, the percentage. Assuming that this contract is to be recognized over time, we must consider the step 5 of the revenue model. In accordance to FRS 15, the progress can be determined based on input method or output method. As discussed earlier, we should use whichever method that better estimate the progress completed to date. When we say input method, normally we are referring to the cost incurred basis. Take for example, the cost incurred to date is equals to $20 for this contract. Based on the later estimate, the total expected cost to fulfill the contract is $42. That represents 48%. If it's based on output method, one of the common method is based on survey, the works completed to date. In this case, assuming it's equals to 55%. Again, we should use whichever method that better estimate the progress completed to date. For this example here, assuming we use the input method, which means it's the 48%. Next, we consider step 3, the adjustment for the current period. We need to know the revenue, cost of sales to be recognized in the profit and loss for the year. The approach is we have to consider cumulative to date, how much revenue and cost of sales should be reported in the profit and loss to date. By applying the percentage that we determine under step 2, applying the 48% of the total contract price of 50, the revenue recognized to date should be equal to 24. Next, we have to less whatever we recognize in prior period, if any. In this case, assuming we start to recognize revenue since last accounting period, $19. Cumulatively is 24, minus whatever we recognize in prior year. In the current year, we should report a revenue of $5 in the profit and loss. As for cost of sales, in accordance to FRS 15, we have to use the cost incurred as the cost of sales to date, regardless of the method we use to determine the progress of the contract. In this case, the cost incurred is equal to $20. Less the cost of sales recognized in prior period, $18. In the current year, the company should report cost of sales of $2 in the profit and loss. In the profit and loss for current year, a revenue of $5, a cost of sales of $2 will be reported in a profit and loss. The net positions of this contract, the profits, cumulatively is equal to 4. 24 minus 20 equals to the 4. In prior, the company had reported $1 of profits. Hence, the net impact to profit and loss for current year is the additional $3 profits. Step 3 is to determine the revenue and the cost of sales for current period. Lastly, we look at step 4 to determine the contract positions at the end of the reporting period. There's a formula to determine the contract positions to be reported in the statement of financial positions. First, we have to take the cost incurred to date. Cumulatively, the total cost incurred to date is equal to 20 plus if it's a profits minus if it's a loss. For this example, it's a profits recognized to date, which is equal to $4. The total of these two represent the value of the contract to date, $24. We have to compare this with the amount we bill our customer to date. This will be in accordance with the agreements. Of course, in the exam, this will be based on instruction given to us. Assuming cumulatively the entity billed the customer 21, the contract value is 24, and we billed our customer 21. In this case, there's an amount of $3 yet to be billed. In theory, if we bill a customer, the customer need to pay us for this $3. This represents the assets at the end of reporting period. If the progress billing to date is equal to $29 and the value of the contract is only 24, the difference of $5, that's an overbill, represent a liability. We have to take the cost incurred plus the profits to date. If it's a loss to date, you need to minus equals to the value of the contract. Compare with the progress billing. If it's a positive, it represents an asset. If it's a negative, it represents a liability. Eventually, when the contract is 100% completed, the value of the contract, $50, which is the transaction price, will be equal to the progress billing to date. Eventually, the net of these two should be equal to 0. This is a quick discussion on the step to account for a construction contract to be recognized over time. Step 1 is to examine the overall contract positions, is to determine whether the contract is a profit positions or loss positions. If it's a loss positions, the loss must be recognized immediately, 100%. Step 2 is to determine the progress completed to date, in other words, the percentage, to account for revenue over the period of the construction contract. It can be based on input method, it can be based on output method. Step 3 is to apply the percentage to account for the current period revenue and current period cost of sales. Step 4 is to determine the contract position at the end of reporting period, the amount to be reported in the statement of financial positions. Please refer to page 863. Question 23.2 is a Module A question to discuss the recognition of revenue for construction contract over time. Study the questions, understand the issue. We're going to discuss the question shortly. For this question, we're required to calculate the amount to be recognized in profit and loss for the year end 30th September 2012. 10 marks. Relating to contract A and contract B. The year end for this company is 30th September 2012. We are given the total agreed contract sum. This is representing the transaction price. The estimated cost based on the original budget for A is 36, B is 63. The cost incurred to date at 30th September 2012 is equal to 25,600 for A, 30 is for B. The contract sum certified and billed to date, 28 and 26. Total billing received to date is 22.8 for A and 23.5 for B. Revenue recognized up to last year for A, 18,200, B is 0 because B contract started this year, and cost recognized to date last year is 15.6. The management have reassessed the cost budgets and considered that the original budgets for A is reasonable. I assume it's unchanged. The budgeted total cost for B should revise upward by 5%, which is equals to 66150. From here we can see that transaction price is 65 million only, but the total cost is 66.15. That means consider as loss making. If it's a loss making contract, we must recognize the loss 100%. Whereas for contract A, the transaction price is 42, the total cost expected to be 36, is a profitable contract. For this question, management determined the revenue from contracts recognized over time based on percentage. We need to know how to calculate percentage. The question mentioned that stage of completion is determined based on survey of work performed, which means based on output method. The output method is referring to the contract sum certified to date. In the statement of profit and loss and other comprehensive income for 30th September 2012, what should be contract revenue and what should be our contract cost of service? We have to calculate this figure relating to contract A and B. Let me go one step further to do a discussion. How would this affect our statement of financial positions at 30th September 2012? Balance sheet, statement of profit and loss. We have to calculate all this figure. We have to apply the 4 steps. Working 1, we have to look at the overall positions of these two contracts, contract A and contract B. The transaction price for contract A is equal to 42 and transaction price for B is equal to 65, remain unchanged. The cost incurred to date for contract A, the question mentioned is equals to 25,600, whereas for contract B is equals to $30 million. And the total expected cost for contract A remain unchanged, is equals to 36, and for contract B increased by 5%, 66150. The cost to complete. For contract A, we need to incur another 10,400. For contract B, we need to incur another 36,150. Based on this, we say that A is considered as profitable. We take 42 minus 36. A is profitable, whereas B is considered as loss-making, 1150. This is expected loss. If it's profitable, we recognize based on percentage. If it's loss-making, it's considered as onerous. We must recognize the loss 100%. That's the first step. A and B. We look at step 2, working 2, determine the progress completed. In other words, the percentage. The question mentioned that we should be using the survey method. Survey method, in other words, is the output method. The contract sum certified and billed today is 28 for A, for B is 26. 2826 over the transaction price, 42 and 65 for contract A and contract B. Contract A is equals to 2/3 completed. Contract B is equals to 40% completed. Step 3, we have to calculate what is the revenue, the cost of goods sold, and the profits for current years. We have contract A, contract B. A, B. We look at the contract revenue to date, the cost of goods sold to date, and the profits to date for contract A and contract B. To date, the revenue we recognize to date for contract A is the contract sum certified. The revenue that we recognize for contract B is also the contract sum certified. 28, 26. Cost of goods sold, we have to take 2/3 of the total cost, 36, and 40% of 66,150. 2/3 of the total cost for contract A, they give us 24,000. 28 minus 24 equals to 4. Cumulative, there's a profits for A minus recognized in prior. In prior, contract A recognized revenue of 18.2. Cost of service for contract A recognized up to last year is 15.6. 18.2, 15.6. This will be the current year adjustment. For contract A, 28 minus 18.2. For contract A, have a revenue for current year is equals to 9.8. For contract A, the cost of service to profit and loss will be 24 minus 15.6 equals to 8.4. Contract B, 40% of the total cost. Just now we took 2/3 of 36. 40% of 66,150 is equals to 26,460. 26 minus 26,460. There's a loss of equals to 460. Earlier we say that our loss recognized for contract B should be 100%. It should be equals to 11,560. Based on the 40%, loss recognized today is only 460. This is not enough. In order to make out the 150, we must make provision for the additional loss, 690, to make out the total loss to date, 1150. 690 is the amount that we must recognize in P&L. Cumulatively, revenue from contract B should be equals to 26. The cost of goods sold or cost of service, including the provision for loss, should be equals to 27,150. This will be the current year adjustment for contract B. Revenue 26. The cost of goods sold 27,150, including the provision for loss. These are the figures that we must account in profit and loss, profit and loss, profit and loss. Can we take this figure to put in a profit and loss? Revenue for contract A should be equals to 9,008 plus revenue from contract B, $26 million, minus the cost of service for contract A, 8.4. The cost of service, including for provision for loss for contract B, for this year should be equals to 27,150. This is the figure that we expect to see in the profit and loss for contract A and contract B. What are the figures that we have to show in the balance sheet? First, under the header current assets, there is a trade receivable or receivable under the contract account, referring to the information given to us for contract A and contract B. Contract A, we bill 28,000, but we only receive 22,800. The difference is the amount that we have not received. That is considered as trade receivable. Same for contract B, bill 26,000. The customer only paid 23,500. The difference is considered as trade receivable. The trade receivable for contract A, the billing made is equals to 28, but the entity only received 22,800. For contract B, the billing is 26 and the customer only paid 23,500. The amount worked it out to be $7.7 million. Next, we look at the contract account. Step 4. Now we look at the contract positions. For contract A, and contract B. Adopt the usual step. Take the cost incurred to date. The cost incurred today is not the cost of sales. For the cost incurred today is this amount, 25,600. For B is 30,000. 25,600 and 30,000. The profits or loss recognized to date. 4,000 is the profit recognized to date for A. This is the loss recognized to date for B, but at the same time we must recognize the provisions for contract B. Profit recognized to date for A, we plus. Loss recognized to date for B, we have to minus 460 minus 690. If you're interested, so a subtotal 25,600 plus 4,000. The value of contract A is equals to 29,600. For contract B, the value is equals to 28850. Less progress billing to date. The progress billing for contract A and contract B is equals to 28 and 26. 2826. For contract A is a positive of 1,006. This represents an assets balance. For contract B is also a positive figure, 2850. It's also assets balance. These are the two figures that we need for our balance sheets. Contract account or contract WIP. For contract A, based on discussion just now, is equals to 1,006. For contract B is 2850. For this question, you're only asked to do the profit and loss. I'm just doing this for discussion purposes. Please refer to page 832. Number 6, sales with rights of return. When there's a sales with right of return, this is treated as a variable considerations, because if the customer return, we don't earn. If the customer don't return, we earn. Do we account the sales with a right of return at the point when transfer the goods, or at the point when there's expiry of the rights to return? Please refer to page 839. Now we'll look at a rights of returns. A right of returns is a form of variable considerations. If it's a variable consideration, remember we discussed earlier on, it must consider the constraint. A good sold on sales or return basis should be excluded from transaction price for revenue recognitions unless it's probable that highly likely will not result in significant reversal. So if we consider the information given to us, whether it's likely the customer is going to return. If it's uncertain the customer is going to return, then we cannot recognize revenue yet. If there's evidence to say that the return highly likely will not result in significant reversal, then we include. If we include, it must be based on the expected value approach or the most likely outcome approach, whichever best estimate the amount of revenue that we're going to earn. This is the step discussed to exclude, meaning that it's not highly probable that you will not result in significant reversal. So we have to exclude from revenue at the point of transfer. We only recognize revenue when the rights to return is expired. When we account for revenue, we must exclude the expected return, and this expected return will be in the form of contract liability and have a right to take back the assets. We call this as return assets. And the cost of goods sold should be based on the amount of goods that on revenue that the company can recognize. We have to reduce our inventory because this inventory is with our customer. Please refer to page 885. Question 23.10. This is a FEA questions to discuss the sales transactions with a rights of return. Study the questions, understand the issue. We're going to discuss this question shortly. With reference to the relevant accounting standards, advise the Finance Director Lee on revenue recognitions in relation to the sales of 2,000 dining table under the 3 proposal. For this question, we only need to discuss Step 3, determine the transaction price. Step 5, recognize revenue when or as the entity satisfied the performance obligations. The group has been engaging selling different types of ready-made furniture. The financial year is 31st December. CHL is a wholly owned subsidiary of the group. CHL is currently under discussion with GAL, which is the customer, and CHL is the supplier, to sell 2,000 dining table with the following proposal: X, Y, and Z. Proposal X, 2,000 dining table at total consideration of $10 million. 10 million over 2,000, 1 unit is equals to $5,000 per unit. With a rights to return and get a full refund within 180 days after the item are shipped to the customer, and the return is subject to a cap of 10%, not more than 200 table. This is a sales of goods with rights of return. This represents variable considerations. We can only include the variable considerations as part of transaction price if it's highly probable will not result in significant revenue reversal in the subsequent period. Proposal Y is similar to Proposal X, except that the consideration is increased to $10.5 million, another $500,000, 5250 per unit. And the return is subject to a cap of 30%, which means 600 tables. Proposal Z, similar to Proposal X, except the consideration is decreased to 9,800 per unit is equals to 4,900. In return, the customer are required to pay a restocking fee of $1,500 for each unit's return. Since the group does not have previous trading relationship with GAL, they have to be more prudent. It's on cash on delivery basis. The group expected the product return rate would only be 10%. You will incur refinishing and repackaging costs of $600 per unit for any item that return. The inventory cost of these 2,000 units is equal to $6 million, $3,000 per unit. This is the expected rate of returns. Proposal X, based on a contract, they can only return up to 10%. 90% can be accounted for as revenue. For Proposal Y, although we only expect 10% of return, but the customer can return up to 30%. As GAL is a new customer, on a prudent basis, we should account revenue up to 70%, because it's not highly probable that the customer will not return the 20%. Proposal Z, there's a cap of equals to 10% because it's similar to Proposal X. For Proposal Z, we should recognize revenue up to 90% because the return is subject to a cap of 10%. Refer to page 887. Proposal X, Y, and Z. The cash received for these 3 proposals, as indicated in the question, is equals to $10 million for Proposal X. For Proposal Y is equals to $10.5 million, and Proposal Z is equals to $9.8 million. The revenue that we can recognize that highly probable not result in significant reversal in the future periods. For Proposal X, we say is equals to $10 million multiplied by 90%. The maximum that the customer can return is 10%. We can say that 90% of the proceeds can be recognized as revenue that is not subject to reversal. $9 million that we can recognize as revenue in profit and loss. The balance, we take this minus this. The difference is the amount of revenue that we cannot recognize is considered as unearned income. Unearned income is the contract liability. The balance is equals to $1 million. For Proposal Y, Although the company expects 10% that's subject to return, but given that this is a new customer, the customer can return up to 30%. On the prudent basis, the 20% we cannot recognize as revenue yet. 20% was still considered as a contract liability because we cannot conclude that highly probable that we will not result in significant reversal for these 20%. The revenue that we can recognize is only up to 70%. Revenue that we can recognize for proposal Y should be equals to 7350. 7350 we can recognize as revenue. The amount we cannot recognize revenue will be the balance, equals to $3.15 million. Proposal Z, the amount of revenue that we can recognize subject to 90%. At the same time, for the 10%, if they returns the table, they have to pay a restocking fee of $1,500. Take 10% of the 2,000 units, which is 200, and the customer have to pay a restocking fee of $1,500 if they returns. We say that this is the amount that we don't expect to return. We can recognize revenue. If they return, they have to pay a restocking fee. This amount we also earn, certainly, if they return. The total for this will be equals to 9120. This is the amount that we earn. How much we have not earned? The balance, 680. There's a decrease in inventory. Cost of this 2,000 unit of table is $6,000. We must take out for inventory. Some of this will be subject to return. We call this as return assets, after accounting for refurbishing costs. For proposal X, we expect 10% to return is equals to 200 unit of table, and the cost per table is equals to $3,000. And for every unit returned, the company have to refurbish the return units. The cost to refurbish the return units is equals to $600. 3,000 minus 600 multiplied 200 units. The value of the return assets after accounting for refurbishing costs is equals to 480. How much is the cost of goods sold that we must recognize in profit and loss? We have to take this minus this, equal to cost of goods sold. 6 million minus 480, the cost of goods sold is equals to 5520. We apply the same concept to proposal Y. For proposal Y, we expect to have 30% of goods returned, which is equal to 600 units. 600 units, the cost per unit is 3,000. For every unit that return, we have to refurbish the units at a cost of 600. The value of the returns is equals to 1,440,000. What is the value of the cost of goods sold to be recognized in P&L? The difference between these two is equals to 4,560. For proposal Z, we expect to have a 10% return. 10% return is equal to 200 units. It's the same as proposal X. Put it here. Minus equals to cost of goods sold, 5520. This is the amount that will be recognized in statement of profit and loss, and this is the amount that recognized in the statement of financial positions. For discussion purposes, let's look at the journal entry. For proposal X, we have to debit cash. We receive $10 million, and out of this $10 million, we say revenue should be equals to 9,000. This amount. The 1,000 is remain unearned, considered as a contract liability. If you account for revenue, you must account for the cost of the revenue. Credit inventory, which is equals to 6,000. Out of this 6,000, amount that is subject to return after the refurbishing cost is equals to contract assets is equal to 480. Debit cost of goods sold in profit and loss equals to this amount, 5520. This is the entry for proposal X. Cash received for proposal Y will be equals to $10.5 million, this amount. And out of this $10.5 million, how much already earned? 7,350. Unearned is equals to 3,150, which is this amount. We must take out $6 million from our inventory. Out of this $6 million, how much is subject to return? Is equals to 1440. And the balance will be accounted for as cost of goods sold, 4560. Proposal Z. Received is only 9,008. Out of this 9,008, a revenue that we can recognize is equal to 9120, and there's a contract liability of 680. We have to reduce our stocks by 6,000 in all three proposals. But for proposal Z, amount that's subject to return as an asset will be 480. The balance is considered as a cost of goods sold, 5520. So this is proposal X, proposal Y, proposal Z. Part A, determine the transaction price. Proposal X, the transaction price is $9 million. Proposal Y, the transaction price should be equal to 7350. And proposal Z is equal to 9120. 9,7350 and 9120. For this question, we recognize revenue at a point in time when the product are delivered to customer. After that, we must account for the return liability. Return liability for proposal X is equal to 1,000. Proposal Y is 3150. Proposal Z is equal to 680. X, Y, and Z. Then we must account for contract assets. The rights to recover goods from customer. X is 480, Y is 1440, and Z is equal to 480. X, Y, and Z. Please refer to page 832. Number 7, consignments arrangement. For consignment arrangements, the entity should not recognize revenue when the goods are transferred to the agent. The entity should only recognize revenue when the goods are sold to third party. Please refer to page 853. For consignment arrangement under IFRS 15, revenue should not be recognized because the control is not transferred if it's a consignment arrangement. These are the factors to indicate that it's a consignment arrangement. You may want to refer to example 18 on your own. Please refer to page 832. Number 8, bill and hold arrangement. Under a bill and hold arrangement, the customer asks supplier to hold the goods on behalf of the customer and bill the customer accordingly. In this case, the supplier, which is the entity, can recognize revenue from the transactions even the entity is still holding the goods on behalf of the customer, provided the criteria are met. Please refer to page 852. Bill and hold arrangements. Revenue is recognized because control is transferred under a bill and hold transactions. If and only if all of the following criteria are met under a bill and hold transactions. The reason for bill and hold transactions is substantive. Generally means it's under the instructions of the customers that the supplier have to hold the goods on behalf of customers and bill the customer accordingly. The product is ready for physical transfer to customer anytime. The product is separately identified for that customer, and the supplier cannot use the product or direct the product to another customer. When all these conditions are met, revenue should be recognized because control is transferred. Again, you may want to refer to example 17 on your own on bill and hold arrangement. Please refer to page 832. These are the issues that we discussed so far. The last issue I want to discuss is the license of intellectual property. Please refer to page 856. Accounting for revenue from licensing fee of intellectual property, there are two factors to consider. First, whether the license is a separate performance obligations under the contract, and the nature of the licensing arrangements. Is the license separable from other performance obligations in the contract? Yes or no? First of all, we'll talk about yes, which means the license is a distinct performance obligations in the contract and is to be accounted for separately. If so, the second step we have to consider the nature of the licensing arrangement. Is the arrangement allow the customer to use the intellectual property or access of the intellectual property? If the arrangement is for the customers to have a right to access the company intellectual property, if so, control is transferred over time, revenue should be recognized over time. If the customer have a right to use the entity intellectual property, control is transferred at a point in time. Example of arrangement for the customer have the right to access the entity intellectual property, for example, brand name, franchise arrangements. For this type of arrangements, the entity involvement over the periods is required. That means the entity is required to undertake activity to maintain the brand name, to maintain the franchise, so that the customer can benefit from this arrangement over time. If the arrangement is for the customer have the right to use the entity intellectual property, the entity have created a software, created a media content, and the customer have the right to use this software and media content, the entity involvement is not required over the period. The entity is not required to undertake activity to maintain this software. If that's the case, the customer have the right to use the entity intellectual property and control is transferred at a point in time. Revenue should be recognized at a point in time. In accordance to FRS 15, revenue should be recognized over time for license of intellectual property if all these criteria are met. The entity expects to undertake activity that will significantly affect the intellectual property. Under arrangement over the period, the entity is required to advertise, to do marketing, to maintain the brand name. This is one of the criteria suggesting that the customer rights is to access the intellectual property. Number 2, the customer is exposed to positive or negative effects as those activities occur. If the entity do it well, the customer benefits because of the awareness of the brand name. Number 3, the activity do not result in the transfer of goods and services to customer as they occur. The entity undertake activity is to maintain the brand name, is not to provide a service to customer. When these 3 criteria are met, this represents the customer have right to access. If one of these criteria is not met, that means the customer have the rights to use the intellectual property. If the customer rights to use the intellectual property, revenue should be recognized at a point in time. If the right is to access the intellectual property, we should recognize revenue over time. Is to use at a point in time. If the arrangement involves royalty fee based on sales of usage, revenue from the licensing arrangement should be recognized only when the sales or usage occur. Earlier we said the license is a distinct performance obligations under contract. We account for the license of the intellectual property separately. What if the licensing arrangement is not a distinct performance obligations? It must be combined with other promises to form a single performance obligations under the contract. Thereafter, we have to consider these performance obligations. Do we recognize over time or at the point in time by referring to step 5 of the revenue model? If this single performance obligation involves royalty fee based on sales or usage, we have to consider, is the license the predominant item in the single performance obligations? If the license is not the predominant item in the single performance obligations, the royalty fee should be considered when determining the transaction price in the form of variable considerations under step 3. If the license is the predominant item in the single performance obligations, The royalty fee should be recognized as revenue when the sales or usage occur. Let's look at an example for this. Please refer to page 889. Question 23.11 is the FEA questions. This question discusses the accounting for revenue under a licensing arrangement. Study the questions, understand the issue. We're going to discuss this question shortly. Let's look at the requirement. Let us consider part A only. You are required to explain to the CFO the accounting considerations for revenue recognitions, in particular the identifications of performance obligations, step 2 of the revenue model, determinations of transaction price, step 3, allocation of transaction price, step 4, and the timing of revenue recognitions for the franchise agreement with ATL. 50 marks. For these 15 marks, you must come up with 16 to 17 points for the franchise arrangement with ATL, covering step 2, step 3, step 4, and step 5 of the revenue model for this arrangement. The group opened its own restaurant named Farm Circle in the Central in 2015. The group is currently under discussion with ATL for the franchise arrangements of the restaurant under the brand name. The key terms of the arrangement are given as follows. The group will grant a franchise license to ATL to operate the restaurant under the brand name for a term of 5 years. ATL, the customer, is required to pay $500,000 upon the grand opening of the restaurant at year 0, which is the commencement date of the franchise period. On top of that, ATL is required to share 5% of the net sales to the group over the 5 years, payable on quarterly basis. ATL is required to make purchases through the supplier designated approved by the group to ensure the quality of the food supply. ATL is required to follow the pricing strategy and the use of the latest menus as directed by the group. The group is required to maintain the brand name through marketing event, and the group is required to keep the menu updated according to the changing customer preference during the 5-year period. The group would also provide all the necessary assistance and training to ATL over the 5-year periods. The assistance mainly include the cooking trainings using the secret recipe of the group. The secret recipe is a trade secret of the group. Based on this arrangement here, the group is required to advise on the pricing strategy. The group is required to update the latest menu. The group is required to maintain the brand name. The group is required to provide assistance and training. There are a couple of activities under this arrangement, but all these activities to be executed by the group is not to provide service to the customer. Instead, is to maintain the franchise arrangements. These franchise arrangements provide the customer with a right to access the brand name of the group on the restaurant operations over a period of 5 years. And those activities mentioned here are not to provide services to the customer. Instead, is to maintain the brand name of the restaurant operations. Part A, identification of performance obligations under the contract. Step 2. The groups have promised to maintain the brand of the restaurant operations, provide all the necessary assistance and training to ATL during the license periods. This activity is not to provide service to the customer. Instead, they are part of the promise to grant the franchise license to maintain the brand name of the restaurant operations over the period of the 5 years. Hence, they are not distinct from the context of this contract. This marketing activity, the assistant training, updating of the menus, these are not distinct in the context of this contract. The franchise right is the only performance obligations identified in these arrangements. The nature of the group promise is to provide the rights to access the group intellectual property through the license over a period of 5 years. For step 2, in this case, there's only one single performance obligations. The marketing activity, the assistant, the trainings, the updating of the menus, all these are considered as highly interrelated to the franchise brand name of the restaurant operations. Step 3, determinations of the transaction price. Step 4, allocation of the transaction price. For these questions, allocation of transaction price is irrelevant because there's only a single performance obligations under contract. You have to spend more time to discuss the determination of the transaction price. The transaction price are in two forms. First is the royalty received from ATL of $500,000. This represents an advance payments at year 0. The control is transferred over a period of 5 years. Hence, the transaction price should be adjusted for significant financing components over the period of 5 years. As for the sales-based royalty of the 5% share of the net profits, do not need to account for significant financing components because this 5% sales-based royalty fee vary in accordance to the future sales, not substantially within the control of the group. In account IFRS 15, significant financing component is not considered for such royalty fee. Since there is only one single performance obligation under contract, allocation is not required. Timing of revenue recognitions. Step 5. Revenue should be recognized over time or at a point in time for license of intellectual property depending on whether it's a right to access or whether it's a right to use. These arrangements involve the rights to access the company intellectual property over the period of the 5 years. Because the involvement of the group is substantially required, the group is required to undertake activity over the period of 5 years to do the marketing, to do the training, to update the menu, to provide advice to ATL over the period of 5 years. This kind of activity will significantly affect ATL interest. And this activity, remember we say, is to maintain the brand name of the restaurant operations instead of providing services to the customer ATL. The 3 criteria met. When the three criteria are met, this is in the form of rights to access the intellectual property. If it's a right to access the intellectual property, revenue should be recognized over time. Unless the question indicates otherwise, normally we recognize on straight line basis unless indicate otherwise after considering the significant financing component. As the 5% sales-based royalty fee, we do not consider this as a variable considerations. Instead, we should recognize revenue from the 5% sales-based royalty only when the sales occur. That's all for part A. For part B, I leave it to you. You attempt the question yourself. We come to the end of these sessions on FRS 15, revenue from contract with customer.